So the mutual funds basically invest in different companies. They invest in, 100 or 50 companies. Hello, everyone, and welcome to our channel, The Mutual Fund Guys, where we speak only about mutual funds. I'm Samir, and on the other side is Mahesh. Both Mahesh and I are partners at AMS Investments. We are a mutual fund distributor in Mumbai, and we manage portfolios for about 100 plus clients. So today's topic is going to be actually quite straightforward and perhaps a little boring for many of you watching, but we thought it is important for us to do this video. Today's video, we are going to talk about the different terminologies used by the mutual fund industry, as well as the fund managers, as well as the advisors and distributors like us. This will give you a sense of how the mutual fund industry is structured and the kind of parlance they use while communicating through their documents, right? So we'll start off, I think, Mahesh, for just for our viewers, we'll start off with some basic stuff about mutual funds, right? So we'll start with something called NAV and units. They both go hand in hand. So NAV stands for the net asset value, and units of a fund I'll explain later, but they both go hand in hand. So let me explain to you what units are of a mutual fund. Just like you have shares in a company, okay, there are also something called units in a mutual fund. But there's a small difference between units of a mutual fund versus shares of a company. So a shares of a company at most point in time is a fixed amount. So there are fixed amount of shares of a company outstanding at any particular point in time. So for example, today Voltas has 33 crore shares outstanding. That's the fixed number right now. So, and the price of Voltas is 1,000 rupees. So the total value of Voltas is 33,000 crores, right? In mutual funds, so the mutual funds basically invest in different companies. They invest in, 100 or 50 companies. And the total value of that mutual fund is the total gross value of all the stocks that's held by the mutual fund, right? Then what happens is that when an investor wants to buy into that mutual fund, the mutual fund will offer units to this new investor coming in. Okay. So every time a new investor comes in, he or she will get units in that mutual fund. Okay. And if you take the total value of the portfolio and you divide it by the total number of units that the mutual fund has issued, that's when you get something called the NAV, or the net asset value of that fund. So let's say, for example, a fund has a total assets of 100 rupees, just to make it simple. Obviously, there is no fund out there which has assets of 100 rupees. It is maybe 100 crores. But just to make it simple, the total value of all the portfolio stocks in a mutual fund is 100. And the net asset value of that fund is 10 rupees. So when an investor wants to invest, say 100 rupees or 10 rupees, he will only get one unit of that mutual fund. So that is something called units and NAV. So I think that's pretty clear. Mahesh, if you want to add something more to that, it would be beneficial.
Yeah. So I think the only thing that I want to say is that the NAV changes on a daily basis. The net asset value changes on a daily basis based on the closing price of all the stocks that they own. The stock prices changes daily, right? But
correct.
So what happens is at the end of the day, the closing price determines what is the total gross value or the AUM or the the gross value of all the stocks that they own. And that divided by the total number of units that the mutual fund has given out decides the NAV. So the NAV changes daily, one, and it determines what is the value at which theoretically everything can be liquidated by the mutual fund, right? That is what the value is. It says, as of yesterday, this is the closing price. We should be able to get out at that value.
Correct. I think just to make it slightly simpler, an NAV is nothing but the stock price of your mutual fund. I mean, just to make it extremely simple. Okay. So when you look at stocks such as Reliance, or you look at, Voltas or HDFC, you see a stock price, right? An NAV, you could say, is the stock price of all the portfolios names divided by the number of units of that fund, giving you essentially the price of that fund. So if you want to purchase that fund or liquidate that fund, the NAV is the value that you need to look at in order to determine what is the value of your holdings, right? So to make it simple, there are differences between an NAV and shares of a company, but just for simplicity, it is basically the value of that portfolio or the mutual fund that you have invested into. That's what NAV is. I want to just talk about one simple term that most people, that the mutual fund industry uses a lot, but many of our clients also are also unaware of these words.
Yeah.
And I think sometimes, Mahesh, people are also shy to ask these questions because they're such simple words, but because they're not from the industry, they don't ask these questions. So we just go through some very simple terms that we use in day-to-day language,
Correct.
but it might be something quite alien to a new person or even an existing investor, right? So let's talk about simple terms. That first one, AUM, stands for assets under management. Okay,
Yeah.
it's nothing but the amount of money a mutual fund manages. That's all. That's what AUM is, assets under management. In fact, there is a fund called the Quant Mutual Fund. They don't even use AUM; they use MUM. Okay, money under management. Okay?
Yeah.
MUM. They call it MUM. So AUM is nothing but money under management. How much money a company is managing is called AUM, assets under management, or MUM, money under management. So that's one thing. We've already discussed NAV and units. Let's
So
talk about one.
NAV into the number of units should be the AUM.
Yeah, it should be the AUM. So NAV also, just to be a little technical, NAV will also subtract or will also remove the expenses that a mutual fund incurs to run its offices and pay its administrative staff and pay its distributors, etc. So the value of the fund minus the expenses will give you the NAV. Now, speaking about expenses, one of the other things which is important is something called TER, okay, which stands for total expense ratio. Now, this is the ratio. This is usually quoted in percentage terms by the mutual fund industry. And on average, the TER or the total expense ratio of mutual funds, mota, okay, there are some which is high, some which are lower, is around 1.5%. Okay, so this 1.5% is what a mutual fund charges the investor for managing his or her funds. These include salaries of fund managers, research analysts, electricity bills, air conditioning,
the marketing people,
marketing, administrative, also audit fees, custodian fees, many other fees that are associated with running a mutual fund. All that is included in the TER, total expense ratio. If a fund is managing 100 crores, okay, he or she would charge 1.6%, which is 1.6 crores to manage that fund, right? I mean, you need to have an office, you need to have buildings, you need to have staff, you need to pay for all these things. So this is where the mutual fund company makes its money for managing your funds. So this is called TER, total expense ratio. And generally speaking, the higher the total expense ratio, the lower is your NAV, because your NAV deducts the total expense ratio in order to calculate the NAV, right?
Well, it's also important to say that what they do is that the total TER, the total expense ratio, divided by 365 is deducted from the NAV on a daily basis. So the impact is not visible to the investor because the amount deducted is extremely small. And that extremely small amount is deducted on a daily basis. And so whatever returns that we are talking about all through these videos and all through the time that we ever talk about returns, it will be net to the investor. So it is not, the TER is not deducted after that. It is always net. So it's
so it's actually, when you see the NAV of any fund, it includes the deduction of the expense ratios from the capital, right? So that's being said. So now I think these are some of the more basic but also very important terminologies that we use in our industry, and they're quite simple and straightforward. There's nothing really miraculously magical about these ones. We'll now move into, I think, Mahesh, talk about the more commonly used terms that I think most of the media uses.
Terms.
Like there are 3 or 4 terms, which is, one is obviously SIP. SIPs is used everywhere. On billboards, you'll see it everywhere, right? Then we'll also talk about SWP, STP, and also something called switch. Okay, this is another terminology. So I think SIP, I'm pretty sure everybody knows what SIP is, but I'll just say it. SIP stands for Systematic Investment Plan. And it's basically a certain amount of money that gets deducted directly from a bank account and goes directly into a set of mutual funds or a mutual fund, depending on what you've chosen. And that's a one way of actually getting yourself committed into a journey of investing in mutual funds. And it's probably great for people who don't like to time the markets, who like to participate in the markets as and when they get the money, and they use the SIP route to do that. So this is actually fairly simple, and I think most people are aware of SIP. SIPs has usually been marketed as a anti-volatility tool. So you sort of invest through the year, and in the year, in most cases, there will be ups and downs in the market. So you sort of try and catch the variation of the market and get a sort of standard rate of entry point. The other one is called STP, okay, which stands for Systematic Transfer Plan. Now, this is actually also a great tool that has enabled the mutual fund industry to grow. Is a lot of people will systematically move from one mutual fund, one scheme within a mutual fund into another scheme in that same mutual fund. So, for example, a lot of people, what they do, Mahesh, is they will park a large sum of money in a liquid fund, if they have some capital with them, and then systematically transfer that money every month or every week, depending on what they want, into an equity fund or a debt fund or a hybrid fund, right? So this is called a systematic transfer plan. Okay.
Yeah, this is actually done, and it is a good idea because nobody can time the market correctly. And if you have a lump sum or a large sum of money which needs to be invested, and there could be various reasons you get a large sum of money in your hand. One could be a bonus, one could be you have sold a real estate property and you need to invest.
Family inheritance.
So various reasons, right? So whichever is the reason, if there is a lump sum that is there to be invested, it is not wise to put all of it straight away into a equity mutual fund, maybe equity part of the fund.
Yes.
So we always suggest that you do a systematic transfer plan. First, put it into, like you said, a liquid fund, maybe a fund which is not risky at all, and therefore after that invest on a regular basis into the fund that you really want to invest in. So that's a great tool, the STP.
STP, and there are many use cases for STP. One could be the liquid fund. So you have some money in liquid fund and systematically it gets transferred to an equity fund or a hybrid fund. But also sometimes what people might do is that they've invested in a particular scheme, say, for example, they've invested into a hybrid fund, but now want to eventually move into a more equity oriented fund. They can do an STP. There are various cases for doing STP, but the only thing to remember in STP is you can only transfer funds from one scheme within a mutual fund into another scheme in that same mutual fund. It cannot be to a different mutual fund. For example, if you invest money into a Parag Parekh liquid fund, you could transfer from Parag Parekh liquid fund to, say, in a Parag Parekh flexi cap fund or a Parekh dynamic asset allocation fund, but you cannot transfer from Parag Parekh liquid fund into an Access mutual fund or Access small cap or mid cap fund. That's not possible. You'll have to actually sell the liquid fund and then invest directly into the Access mutual fund. So that's the only sort of difference between, not difference, but that's the one thing you need to keep cognizant about, that you can only transfer within the AMC itself, not outside the AMC. Which is now the next one is SWP, which stands for Systematic Withdrawal Plan. Okay. Now this is actually, as the name suggests, it's quite simple to understand. It's systematically withdrawing money from your mutual funds. So if and there are again many use cases for this. There are some people who are wanting a certain amount of money every year to fulfill the retirement needs, or there could be people who need certain money coming every month to fulfill a certain expense. Either it's running a house or paying school fees for the children abroad. There are various cases for it, right? But it systematically takes money out of that particular fund that you're invested in over a period of time. And you can define that period, how much you want, whether it's 1 year, 2 years, 3 years, whatever it is, right? But it's systematic. So every month, a certain amount of money fixed would be removed from your fund and given to you in your bank account. And of course, there are some taxation laws that kick in and when you withdraw that money. If it's below less than 1 year, then it's a 15% tax, depending on if it's an equity fund. But depending on the fund you're invested in and depending on the withdrawal that you're doing, your tax bracket makes quite a bit of a difference. So again, there are use cases for SWP as well. I see it more for people who are nearing age of retirement. Also, they have invested quite a bit of money in funds and now want to withdraw that systematically. But they also don't want to withdraw everything in one shot. They want to do it over a period of time because the money that is remaining in that fund will make some money for them as they sort of age through the years, right?
Yeah.
So
you're right. It's like replicating a salary even after you retire, right?
yes.
You want a salary to hit your bank account on the
Yeah.
5th of the month, say. You can do that by
Yes.
starting a SWP so that on the 5th, a certain sum of money comes regularly, right?
Correct.
So SWP is an incredible tool, right? Like you said, for a retiree. And
there is also another use case for SWP, which some people have done it. I mean, for them, it's regular profit booking in a fund, right? Even 30-year-olds and 40-year-olds who are not anywhere close to retirement age, they will do an SWP just to book some profits as they go along.
Yeah.
There's no guarantee that there are profits to be made every year. But sometimes they just like to withdraw the money.
I don't know whether it's a great idea.
It's not a great idea, I think, yeah.
I don't really subscribe to booking of profits because nobody really knows anything about that.
Exactly.
We keep talking, and I think the best thing is really long term. And we will make videos on why long term.
Yeah, we're going to do a video on that very soon, Mahesh, and why long term is important. But yeah, and we generally don't suggest anybody to either, I mean, personally speaking, I don't like to shift too many funds and not like
unless
to
you really need the money.
Then you need the money. Some people do it because they believe that they can time the market, or they believe the markets are overpriced, or they want to withdraw the money, but they want to withdraw it systematically or the next 1 year. There are many use cases for SWP. So we've talked about SIP, STP, SWP, and the last one we'll talk about is called something called switch. Switch is again similar to STP, but not exactly the same. So if you are invested in a particular scheme in a mutual fund and you want to switch to another scheme within the same mutual fund, that's called a switch. It's a one-time
it's a one-time thing instead of a regular thing.
Yeah. So STP is regular intervals. You switch from one scheme to another scheme. Switch is more like one time. Like I want to shift a bulk amount or I want to do it one time only. This is called a switch, right? It's more of a convenience factor offered by AMCs. Instead of you selling that fund, okay, then you get the money in a bank account, then you buy another fund. This just helps you do it in one single swing, right? It's more of a logistical
thing. It's just that you put in one order and both the things, the sell of a particular scheme and the buy of another scheme happens simultaneously.
And it's convenient it's convenient for the investor because you don't have to wait for the money to come, then again reinvest back. I mean, it just gets done for you in one sort of place through the AMC himself. So the AMC, and again, it's important to note that you can only switch between schemes within an AMC.
The AMC,
like you do an STP as well, you can only do a switch within the scheme itself. So I think these are the few things that I believe are important for us to talk about. Is there anything else, Mahesh, that you feel that, we often talk about it in the media or with our clients, but sometimes we fail to realize that it's not that clear?
No, I think you handled it. You said everything that we need to talk about.
Yeah, there are of course many other small parlances. I mean, some sort of terminologies out there which is more akin to debt funds in terms of various things such as duration and all of that, but which is a little bit complicated.
Yeah,
but I think for most investors, having to know a few things like these things we spoke about: units, NAV, AUM, SWP, STP, SIP, switch. It's more than enough. I think you don't need to really. And if you have any questions, you can always ask a distributor or your advisor. We're always here to help to answer all complicated questions. But the purpose of this video was very simple. And I think there is nothing wrong in asking these questions. I think some investors, including some of our own clients, have sort of shied away from asking these questions as to what is SWP and what is STP and when can we do this?
It's our fault to a certain extent, right? Since we are so much involved with this industry, we assume that these are terms or words that everybody understands, right?
You'll be surprised that people sometimes don't know what NAV is.
In fact, a good example, the good thing you said, that a lot of people, and I should, have come to me and said, why are you buying a mutual fund with 100 rupee NAV? Why don't we buy a 10 rupee NAV mutual fund, right? So
that's not a very, that's a tough.
and the answer
See,
is that NAV actually by definition means the value as of yesterday.
yeah,
So whether it's a 10 rupee NAV or a 100 rupee NAV, you're basically buying it as of whatever was the value of the fund. NAV defines
yes.
what was the value of the fund as of yesterday. So it doesn't matter which NAV you buy.
And it's not the question about what the share price is. It's you have to understand how the company is capitalized, how many shares are outstanding, and how is that pie divided, right?
Yeah.
So if a mutual fund has 500 crores of assets under management and only has 50 units, then the NAV will be very high. Whereas if a mutual fund has 500 crores of assets under management and has 50,000 units available, the NAV will be very small. But the value of the AUM is the same. It's the same AUM, it's the same amount of money, right? It's how you divide up the pie. So lower NAVs are not necessarily cheaper. By no means, there's no exception to it. And high NAVs also doesn't mean it is expensive. There is no correlation. This is not the same concept as an IPO. IPO, my people usually put money in because they believe the IPO is priced lower, and then there will be some kind of upside on the listing day. In mutual fund, is not that same. Okay. In mutual fund, in NFO is priced at 10 rupees. Okay. It is mostly done appeal to the sensibilities of the investor, right? Saying it's 10 rupees, NAV is 10 rupees, small sized unit, you can buy a few units. But again, there is no upside to buy an NAV of 10 rupees versus an NAV of 85 rupees of another fund, which is in the similar category. So you should be agnostic to both these values, because NAV does not define or tell you anything about how cheap or expensive
in the future,
stocks within that fund are, right?
Yeah.
So please refrain from even thinking on those lines, because they make no sense. So just like, don't need to buy stocks which are priced at 2-3 rupees versus stocks that are priced at 5,000 rupees. There is it's a completely different, it's not an accurate representation of value as well as what they actually represent. So I think this is Samir. Thank you for watching, everybody. I hope this video helped you. If you have any questions, you can please write to us at hello@amsinvestments.net. Mahesh and I would be more than happy to sort of answer any question that you have regarding this industry. If you're looking to invest through us, more than welcome. And if you are looking to get your doubts clarified, also more than welcome. And we hope that we see you soon in the next video. Thanks for watching. Bye-bye.